What would you do if the market dropped 40% tomorrow? One of the hottest things to discuss that always gets clicks is the fated impending market crash. Everybody always thinks we're in a bubble or that we're cooked or that we're heading towards another 2008 level crash again. So, let's discuss how you can hedge your bets against that actually happening. So, as we know, Michael Burry famously predicted the 2008 housing market crash, and he won big betting against those mortgage-backed securities. Famously, up until that point, a very safe investment. Since then, Burry has made many crash warnings, but we haven't had that kind of drawdown in nearly 20 years. So predicting these things is extremely difficult. Market crashes, however, do not destroy disciplined investors, but they do destroy over-leveraged and emotional investors. The bull market of the past couple of years, as of 2026, has us all thinking that we're going to pick the next diamond in the rough stock that's going to rocket up 2,000% once Nvidia announces a special stake in it and Jensen busts out the leather jacket, right? It's easy to get emotional and cloud your judgment in these kind of good times in the market when everything sort of seems to be going up. So, naturally, the fear for the crash starts to grow. Even the Warren Buffetts and Michael Burrys of the world can't consistently time crashes, so you got to remember that. AI bubble this, Nvidia is smashing earnings every quarter because they're the greatest company of all time. Companies are taking on tons of debt in order to catch this AI build out. So it's creating a lot of this uncertainty, right? So let's discuss how we can better protect ourselves as non-emotional and non-over leveraged, disciplined investors against this kind of crash. Okay, so the most important thing that you should absolutely do is set up an emergency fund with cash reserves of up to 6 months of living expenses. So, I live in a higher cost of living area, so my half of the rent is pushing $1,500. So for me, that would look like something, over 12K is pretty solid for having up to 6 months of living expenses. So, and this is bare bones essential. So, car, gas, car insurance, utilities, rent, groceries. So the more the better. And as we know, the 2026 market is low-key looking uber cooked. So, if I, for example, God forbid, lose my job, it's going to take me a pretty long time to probably find something that, pays, what my current job pays, or even, to have a decent hourly job because those are generally in demand. It's so sobering to remember that you are one bad market week away from losing your job, or one board member deciding that they need to lay off 15% of the company. So with having that fear in the back of your head, it should really spur you to get this kind of emergency fund set up. It's even better if it's in a high yield savings account. If you don't have a high yield savings account, you can always go into your brokerage and stash that in a money market. But the most important thing is going to be setting up that emergency fund. Another thing that you can do that is good for excess cash is putting part of your portfolio in diversified bonds. So again, last video we were talking about the Roth IRA. Today, this is going to be a little bit more for your taxable brokerage. So buying bonds. Bonds, if you look at the chart, scroll out 5 years, you might think I'm just talking a bunch of nonsense, right? Because they've uber crapped the bed since 2022. And you can thank Jerome Powell and, the Fed printing it into oblivion, right? Because interest rates kind of destroyed bonds. Well, not destroyed, but they're not looking too hot right now. They're not sexy. But if you put them into diversified bonds, so mortgage-backed bonds, you can find these kinds, by just looking them up. You can get them in ETF form, but it gets you the exposure you need. Now, if you've watched The Big Short, or I know you might be thinking about the whole Michael Burry thing, 2008 mortgage-backed bonds were filled with subprime loan junk. All right, it's different now. And I know that might sound like cope to some of y'all. If that sounds like cope, I'm sorry, but mortgage-backed securities are something that you can buy. An additional thing is buying bonds that are U.S. Treasury backed or municipal and corporate bonds. So those do get lower yields than mortgage-backed security bonds, but they do also provide some really nice stability. Because, as we know, when a massive 2008 level event occurs and everything crashes, people tend to go to bonds for safe haven. So inflating your holdings in bonds and allowing you to trim maybe some of your bond holdings and buy the dip on like major mutual funds, ETFs, other equities at a discount. So in order to do that, like to sort of go to the next point, capital inflow is like the most crucial part of all of this. I can't stress that enough. Because we were just talking about, having that 6 month emergency fund, having a job. The most important thing is remaining employed because that's your cash flow. So for like us younger guys, like, I'm 25 and I hold about like 10 to 15% of my total portfolio in bonds. And like when I'm watching the entire market go up, right, and I'm watching the S&P 500 rocket up to 7,000, and Nvidia's printing every quarter, every big tech company is smashing earnings, right? Like it kind of sucks, holding these bonds. But you just got to remember that like if there is a major drawdown event, or if you do end up losing your job, God forbid, this is your ticket sort of out of being really like dangerous, and close to taking extra credit or maybe even debt. So this is something that like you know try to make sure that you have bond exposure. I know it's like not sexy and everyone's going to say like, "Oh, well you're young, go full growth." And it's like if you're the kind of person that's willing to hedge your bets and you know put yourself in a position where even if a 2008 level event did occur again, and that doesn't seem likely, but like 2008 didn't seem likely. So, just remember your risk tolerance in a bull market, that's not your real risk tolerance. So, like, let's say you buy like the hottest, AI stock. I'm full transparency. I'm bag holding some CoreWeave right now, from a cost basis, I think of like in the 90s, like average, and it's trimmed down. And I think like, oh yeah, I have good risk tolerance because the stock I bought, lost like 15% value. That's not true. Like the S&P 500 right now is perceived as safe, but like in the 2007 to 2009 bear market, that total drawdown was like 50%. So, would I stay cool and level-headed, in that kind of like massive crash? I mean, dude, I don't even like. I'd probably be flipping burgers at Wendy's because I'd liquidate everything. I'd like panic so hard, So like the S&P dropped like 40% in 2008 alone. But if you had those cash reserves, if you had the bonds, you would have had like a huge buying opportunity, provided that you're made employed. So like again, that's sort of the key of it is remaining employed, having that capital inflow, yada yada. So like, how do you know when to time these dips? During a major like drawdown, the answer is nobody knows. Like you don't know when the absolute bottom of the market is going to be. So like one thing that you can do is set up like automated investing. So like setting orders on your Schwab or Fidelity, or if you're a Robinhood guy, you can set up automated investing to buy consistently, and that'll set a decent precedent for your cost base average or cost dollar cost average, sorry. So like just remembering that consistently buy and remain disciplined, you're gonna outlast that kind of event. So of course, everybody's a genius in a bull market. You always think the market's going to go up, oh it's always going to recover, but like the 2007 to 2009, that would really test my patience personally. I've never, as a sort of newer investor, as somebody that's really only been paying closer attention these past couple of years, as I've gotten my first job and as I've started investing and opening those retirement accounts and getting everything sort of running, it's really difficult to sort of gauge where my emotions would be during that kind of drawdown. So like I thought that I was good about it. Like I think my risk tolerance is realistic. I think that I know what I'm doing. And this is sort of like it's either Dunning-Kruger effect or it's sort of like the idea that the novice always overestimates their ability. And I think in my case, realistically that's probably where I'm at. So, it's just important to, stay calm and stay the course. I mean, tons of people that you thought were cool, level-headed like boglehead index bros, they're going to bail on a market crash and they're going to panic. And you're going to think like, oh, well, I thought you guys were all about staying the course. So what I would sort of do is when you're, meditating on the possibility of a major market crash, just remember that the most important thing is that our timeline is long term. Like we are investing for our lives. We're investing pretty much all the way up until retirement. So with that kind of time horizon, you're going to witness a lot of things, dude. It's going to be ups and downs, it's going to be party one week, it's going to be feast or famine type shit. So it's crucial to stay level headed, stay the course, and remember that you either buy at an all time high or you buy at a discount. The things I would do to buy, the things I would do to buy VOO, at like $100 a share or something like that. If we could get like a really super affordable, buy after a huge drawdown, like that's going to be so sick once that recovers. And the way you sort of catch that is not by, grabbing the falling knife, and it's not by, trying to time the absolute bottom. It's by remaining consistent and consistently investing. Because, if the market does crash tomorrow, the only thing it will destroy are emotional and over leveraged investors who thought that they knew better. Disciplined investors that, remain employed, key, get a job, and can have consistent access to capital are going to make it out just fine. So to like sort of recap, remember, your like 6 month fund, that's going to be like the most important thing. And making sure that you have some of those bonds so that you can actually sell or survive a market crash. Because like even if your goal isn't to like buy the dip, you don't have, for example, if you lose your job, you don't have access to moving back in with your parents or having a place to stay. The better thing to do would be definitely to hold on those funds and tough it out. But if you you know do continue to remain employed, and you do are able to overcome that psychological battle, downturns are the buying opportunity. That's when millionaires are made. Millionaires are made when you're patient, and patience always wins. So don't rely on the next like GameStop super pump. Don't be that like guy on Wall Street Bets that lost it all in Apple puts. If you know what I'm talking about, bro, just look up good on YouTube. It's peak. It's hilarious. But you can lose a lot of money, but you can also make a lot of money. So just remember, like, crash fear always sells. People are always they're always talking about the crash, because like that's something that if you're a longer term investor, it's sort of in your mind. But if you also recognize your own risk tolerance, and that like this is sort of the game that we're playing, it's better to hedge your bets and get some bonds and cash and be set up for this kind of event. So with that in mind, guys, I'd love to hear from you in the comments. Be sure to like, comment, subscribe. Tell me what your strategy is. Do you think we're in a bubble? Do you think that there could potentially be a market crash? As always, just stay the course, stay classy, and as always, I will see you guys in the next video. Peace.